Ray Buckton here, and I am joined by Ivo Grigorov today from Real Finance. Ivo, how are we doing today?
Hey, actually pretty well. A lot of work and it's been hectic couple of months, but overall, we're progressing very nicely and very excited for our upcoming launch. So all good on our side.
Awesome. I love to hear it, man. Yeah, it's been a hectic time in the market, but when you're head down building, the time just flies. I definitely empathize with that. So I'm super excited for this conversation today, Ivo, and would love to just start with kind of the bigger picture. So I know here in the industry, we're seeing explosive growth across all of asset tokenization. We're seeing projections reach into the tens of trillions now, like $30 trillion is being thrown around on the reg, which is super exciting. But for listeners who are out there and maybe have heard of RWA or are just getting familiar with the space, can you help us understand what's actually broken with current RWA infrastructure that Real Finance is solving?
Well, to be honest, we have been on the market for the past 10 years now. I mean, there is different, let's say, hypes and terms around it. But the thing is, and the fact is that probably the best business case of the blockchain technology as a whole is actually RWAs. And the first step into the RWAs would be, financial instruments which are, let's say, already existing, traded, etc. The problem with tokenization, and I know, the term is widely used so far, but the problem with tokenization is that, first of all, there is a lack of understanding what exactly tokenization means and what RWAs are. And the second one is the trust issues, which people are facing when they're actually trying to invest or when they want to acquire such kind of an asset. So what Real Finance does is that we are purposely built for such kind of assets. We're not just another chain. All other chains so far, they have evolved and they're trying to, let's say, maybe adapt to the market needs. However, they, from existential standpoint, they weren't basically designed for such kind of asset trading. They were designed for digital assets, which, okay. But RWAs are a completely different breed, and maybe perhaps here is the time to just explain what exactly. So real world assets are actually assets which, they exist in the real world. They are cash flow, let's say, generating. They can be acquired within the real world and they are represented in the real world. So it can be anything from, let's say, bonds, the easiest probably asset to tokenize, to real estate, to private equity, or to, parts of a company or parts of inventory. And
Hmm.
in general, those assets are, they have an intrinsic value. And that's where, the whole beauty of the blockchain comes, is that it transitions that value from one, let's say, region or from one basically aspect onto the global stage. And if you do it correctly, you can actually acquire such an asset. It can bring passive income. It can hedge against volatility. People are confusing that RWAs are connected to, let's say, crypto trade. Crypto
Hmm.
is a different story, like the volatility, for example, in the crypto market. Let's say, Bitcoin goes down and RWAs are going down. That's not the case. I mean, if you acquire part of the company, let's say part of the equity, you're basically acquiring shares in the company. It doesn't matter whether they're tokenized or not. I mean, at the end of the day, that doesn't bring the value of the asset down just because Bitcoin is moving. And I
Hmm.
think, these are the main factors we're solving. And especially when it comes to trust, first, as I said, educating people, that's an important step. And second, creating an environment where, those assets are represented, they're evaluated, and they can be traded and interoperable within our ecosystem, basically.
You touched on some really crucial points here, Ivo, and I think that one of the core things is that differentiator between the intrinsically digital tokens like Bitcoin, which are pretty light. If anyone's ever picked up a nano ledger, it's not the heaviest thing, but getting gold from me to you, Ivo, that's a heavy rock because it's a
Yeah.
lot of logistics. So bringing this stuff on chain, I think makes a ton of sense. And what you mentioned about dedicated infrastructure, we've seen dedicated infrastructure arise everywhere in finance. So the idea that, oh, well, it'll be a single ledger or even a small group of ledgers that touches on all of these assets you've mentioned, right? From real estate to gold, et cetera. These are all very different asset classes. So it's a very exciting time to be in this industry. But something you mentioned as well, Ivo, when I was learning about real finance that I found interesting is you all have identified something called the block or the RWA trilemma, which is a derivative a bit of the classic blockchain trilemma that we have in our industry. And what you guys have pioneered here is a really fascinating concept. Can you walk us through these three elements of security, trust, and decentralization, and how these are related to that blockchain trilemma, but how RWA gives us a new set of challenges for us to overcome, and why existing platforms kind of compromise on at least one of these when they're trying to tackle RWAs?
Well, yeah, I mean, it is connected to the first question and to the answer to the first question as well. Basically, the trilemma which we have identified is that, you know, one problem with RWAs is that single point of failure. For example, an issuer of such kind of, let's say, an asset, if they fail, you're basically they default onto their investors as well. So there's single point of failure. So here comes the decentralization aspect where real finance is kind of shining. It's that anyone can evaluate the asset, anyone can participate basically in its, let's say, trading, in its insurance policies, in its evaluation and scoring policies, something which we have embedded into our consensus layer. The second one, trustlessness, again, it's connected to the decentralization model as well. So, you need, in the usual scenario, let's say, you need to trust the asset issuer. You need to trust that the asset is there, it's evaluated correctly, etc. With us, that's outside of the scope. I mean, you have three different layers of tokenization companies which are doing the due diligence and the actual tokenization of the asset. You have asset scorers, credit scorers, insurers who are also insuring the asset. So you have these three key players integrated on a network level, and this kind of solves the trustless and the decentralization aspect to it. And of course, transparency when it comes to real world assets. Usually, let's say, even current traditional systems, what happens is that, for example, a bank has a portfolio of a couple of billion, but nobody knows what's in that portfolio, right? I mean, you need to go to auditors, you need to, look at their audit reports, etc. If you bring that portfolio on chain, everything is visible. And if you involve the scorers, the auditors, the insurers, again on chain, this all becomes very transparent. So you know what the bank is holding. You can invest in their assets. You can invest in, let's say, a similar portfolio. All of this kind of becomes a global stage for investors, both retail and institutional wise. There is so many applications to that method and overall to that approach that 30 trillion, yeah. I mean, I know it sounds like a high number, but it is there. I mean, and we're speaking only about financial assets. If you include like private equity and real estate, etc., on a global level, the number actually even increases. And I think that the applications are there, people are recognizing them, institutions are recognizing them, and we're just scratching the surface at the moment. And that's why we're bringing this necessary infrastructure for this transition to come on board.
That is super exciting. And I love what you underlined here, Ivo, the notion that the total amount of assets available just in the world it's mind-boggling. When I first learned that real estate was 300 trillion with a T, that's it's hard to convey how much money that actually is. The notion that you mentioned of creating this incentive alignment, it's a bit like when Bitcoin first came around. Proof of work existed, and so did this concept of hashing, SHA-256. But when it was put together in a novel way for a purpose-built system, then magic happened. So what you're describing with real finance, the idea that we have this incentive alignment, I think it makes a lot of sense. I'd love to double click on that. You mentioned these risk scorers, business function validators, I believe you called them, that all have these economic aligned functions within real finance. As I was reading through the docs, it mentioned token slashing, and that sounds like we're starting to bring some ecosystem incentives that are aligned and make a lot of sense from a TradFi perspective on chain. So can you walk us through very briefly the roles of some of these validators and their economic incentives to ensure that the system is sustainable?
Yeah, of course. So yeah, basically, as for other blockchains, we have proof of stake embedded into our system and network. However, we have done a dual validation model where, we have the technical validators where processing the transactions, etc. But we also have on top of that, and that's the first time we're basically seeing such kind of a system. That's why we have designed it. We include the business entities into the validation of those assets as well. So as I said, you have three key pillars here. You have the tokenization companies, the scoring companies, and insurance companies, and they all, in order to participate into the ecosystem, first of all, they need to acquire our native token called Asset. As I said, we are launching it in a very short time frame. But then they need to stake it. And of course, once staked, if they perform their tasks as validators well, they will get, percentage of the incentives, etc. However, the important aspect here, perhaps, and that was, the point of your question, is that they get slashed if they are performing poorly. And just to explain a real case scenario, for example, if I have a scoring company which has evaluated, let's say, a credit line or a credit portfolio with a probability of default of, let's say, 20%, and that's all embedded into the metadata of the actual asset. And then it turns out that it was 80%, and basically the portfolio defaulted, and the investor lost money onto it. Basically, the scorers which have actually performed poorly and which have predicted 20%, they will get their stake slashed and their incentives as well. So, um, and I'm kind of proud of that. Coming from the traditional financial system and world, there is this moral hazard which people have faced back in 2008. And to be honest, we're punishing that. We're eradicating the moral hazard as well. Because if you're an auditor or a scoring company and you're not paid to evaluate by the company who is issuing the asset, you would be paid by the network itself. And if you do not evaluate it correctly, you get penalized for it. And so the incentive would be the other way around. Evaluate the asset correctly, bring this trustless environment, let people in, and you get rewarded for it.
So as you're describing that, in my mind, I always go back to the scene from The Big Short where the auditor, the older female in the room, and she had just had an eye procedure, and so she's wearing those blinder glasses. And the notion is to convey, like, yeah, we have these checks and balances, but sometimes they're wearing, blinders or glasses where they can't really see what's going on. So I love what you're doing here in terms of creating that incentive matrix and then punishing the bad actors. But also I want to underline it's an incentive matrix for the good actors as well.
Yeah.
The notion that they can earn from doing a good job. So for example, if I go out and I want to start a pressure washing business and I buy the machine and I go out and do a great job, I'm making money. But if it just sits in my garage, well, I'm going to be penalized, air quotes, in the sense that the thing's going to rust. Eventually it's not going to work and I'm going to lose my initial input. So just doing a good job in general makes a lot of sense, especially when we're talking about an entire financial system and the tokenization of assets.
Yeah.
Love it. So with that said, let's kind of bring it to like a practical approach. So like, let's say, I'm an SME, I want to tokenize my assets on real finance, whether that's invoices or inventory. I'm not sure which one's the most applicable, out the gate in terms of use cases, but can we walk through those three stages that you outlined, Ivo? So we have tokenization, scoring and issuance. I would love to understand, how each validator type looks at an SME's asset and say, okay, let's move this thing on chain, and then how that experience looks like for me as like an SME owner.
Sure. We have been working tirelessly for the past year and a half, also building our business development and outreach towards different financial institutions. I'm mentioning that because it's a prerequisite to basically to the actual work within the ecosystem and how all the pieces fit. So let's say I'm a SME, as you said, like you have I don't know, like 10 million of corporate bond, which you want to tokenize. This corporate bond, you can put it into one of our partner banks, which we have already basically established relations with. One of them is already public, Vina Privat Bank. It's a publicly traded bank in Europe, so all regulations are there. So you put your corporate bond in a custody account within Viner Bank. Basically, from that point onwards, you connect to a tokenization company and you say, okay, I have this corporate bond. It's in a custody account. I cannot touch it while, the token is in circulation and while, investors. So technically speaking, you cannot sell it to a third party, and turns out that the RWA is not, ownership of the token holders, let's say,
Mm.
which again, trust, right? So you go to a tokenization company then. By the way, we have just announced a partnership with Stopbox, one of the bigger tokenizing companies. We also have Bricken, so we already have these pillars which I'm referring to. So you put the bond into the bank, you go to the tokenization company, let's say Stopbox, they tokenize it, so they do the technical analysis, the technical introduction onto our network. They do the due diligence of the company, etc., etc. So the bond is within the bank. You have a tokenizing company who has done, all the audits of the contract, designed the contract, brought it on chain. Then you have the scoring company, right? So you go to the scorer. We're working initially with Experian, which are one of the top 3 scoring agencies worldwide. But anyone can be a scorer, to be honest. Once the bond is on chain, anyone can actually evaluate the company, the balance sheets, etc., and give a score to the bond, which again is a beautiful aspect to it. So Experian scores the bond, puts it into the metadata, scores the token technically, and then you have the insurer. So if the insurer decides that the company has a good, let's say, rating, and they would like to insure the bond, they can offer a premium basically to investors to cover against default. If this happens on chain, while you're basically issuing the token, you are the asset issuer, you receive the funding from it uh, in stable coins, of course. By the way, um, initially we have 20 million at MVP of such kind of assets already committed. The MVP is coming in around 8 to 12 weeks. So we're moving fast in that direction. But as I said, we have all the necessary pieces in place already. And yeah, you're receiving your stable coins, and basically you can operate with this capital any way you see fit. And as long as the bond is existing, it is in custody and the token is circulating, investors can feel safe.
I think it's a phenomenal
So
system there, the checks
funds
and
are safer,
balances.
right?
Funds are seifu, indeed. They're getting more seifu as time moves on
Yeah,
with these kind of systems, like what you're building at Real. I think that
exactly.
makes a lot of sense. And then one thing I want to underline too is like, folks who know me know and can tell by my voice. As an American, we have this thing called a credit score, and I have the Experian app on my phone just because it's a good thing to keep up with, right? So this is, when you mention Experian, that immediately lights in my mind as huge major company that does risk rating, which is phenomenal. And of course, we had Edwin Mata from Bricken on the RWA Pod previously. So these are high quality counterparties where we're
Yeah,
discussing
we're
here.
good friends with him, to be honest. I've been into the space for some time, like met a couple of times, and great guys, and we're happy to involve them into our ecosystem from the get-go.
Absolutely. And it just goes to show great players work together, right? This is comparatively new technology, and it's still comparatively small industry. But one thing you mentioned in terms of, when you mentioned Experian, it immediately got my mind turning, because you did say, Ivo, that anyone can be technically a risk scorer. But ultimately, I'm going to have a hard time competing with Experian. These guys have a lot of expertise and a lot of pedigree behind them. So I'm really curious. The asset grading system, it satisfies the data nerd in me. I love A through F system. Naturally, it's like a report card, right? You're looking for assets if you want minimum risk that are A plus. If you're willing to take on a little bit risk and with a little higher yield, maybe you go for like a C, for example.
Of
But
course.
naturally, like I said, I may give something an A, but it's actually a C. And personally, I would go with what Experian says over me. So how does this work in terms of risk scoring? Do I have the same weight as Experian, or
No,
if they do?
it comes from the proof of stakes. For example, if you're so sure that you're, right more than Experian, and then the system itself would require a higher proof of stake, and of course if you don't get it right, you get slashed. So technically speaking, because you just mentioned the Big Short, if this kind of system existed back then, Kubernetes would have basically predicted the whole thing, put the money into the network as proof of stake, and basically received huge, let's say, even bigger payout. Because the thing is, the retail could have followed his, basically, because everything is transparent and it's on a global level, could have followed his approach, and it would have been even better.
What I love about what you just outlined, Evo, is it gives that real time pricing of risk, right? In
Yeah,
2008, people didn't realize things were kind of not so good until all of a sudden everyone realized.
collapsed. Yeah.
Whereas, yeah, exactly. And this is more of a spectrum where it's like, okay, we see that the risk is mispriced and people can begin to
Oh,
pile
exactly.
onto one
As I said,
side.
like GameStop, also another example. For example, if somebody recognizes, let's say, a pattern or trend, or they have evaluated the asset in a different manner, just because they analyzed, I don't know, that the weather outside is affecting, let's say, crops prices, etc. And they have basically designed a revolutionary, I don't know, scoring model, and they have bet their proof of stake into it. That's how things are done, and that would be public, transparent, and I think that people will recognize the value into it, especially 3 to 5 years from now. There is an initiative which was basically approached in the European Union called PSD2, basically open banking system where all financial institutions can interact between each other and share data. It failed. It failed greatly because, again, it's an internal system. So, you need to pour in the data, etc. The blockchain is public, so anyone can see it. And I think that's one of the biggest game changers out there.
Absolutely. It's just it sounds like blockchain is the system they were trying to build, right? I joke quite often that here in the US, and perhaps it's the same in Europe, all of our banking infrastructure runs on COBOL, which is a programming language from the 60s. So getting these things to talk to each other is it's like going to space, right? It's a whole
Yeah.
project in and of itself. And one thing I'd love to underline too is that this would allow someone like myself to serve as a risk scorer. Let's say I'm uniquely skilled at that in particular. I can set up basically a small mom and pop shop, almost like an SME risk scorer, and kind of work my way up, which is just really great because it allows me to use my expertise and leverage that against, let's say, Experian,
Yeah, that's one
which
of
is
the things we're fairly excited about Real Finance is that not only the trilemma, but it gives accessibility. Like you get access to assets which you wouldn't have to, and also you get basically a chance in finance which up until now hasn't been accessible to the regular Joe. Let's put it that way.
Absolutely. And then I love the notion of if someone works in like a gold mine for 30 years, they know what it takes to run a great operation. And there may be a situation where a gold miner just doesn't pass the smell test for some reason. And even someone with 15 years experience wouldn't catch that slight issue. This person with 30 years experience being a risk scorer, they're going to catch that. So I
Yeah.
love that leveraging of differential expertise and experience. And one thing that's really important is that, your average person, let's say a guy who worked 30 years in the gold mine, not trying to be a risk scorer. Maybe he just wants to invest via real finance and ensure that he's growing his portfolio. One thing that really stuck out to me that we're seeing more of, and I think you guys are doing really well, is the disaster recovery fund. We've seen some of this in Web3, but one thing we're seeing, especially on the heels of Goldfinch, is that there is a risk intrinsic to any investment. Even if you're buying government bonds, the U.S. government could go kaput. Like, it very likely will not, but risk yield is just the price of risk, right? And so this disaster recovery fund is really interesting to me because you're using something called a network debt token to handle defaults without creating inflation. That really stuck out to me as super interesting. So Eva would love to walk through kind of this network debt token and how you guys are handling potential bad ends for any kind of lending activity on the platform.
Well, basically inflation is bad for any, let's say, ecosystem and economy as a whole. So we have, as I said, we have designed a way where, let's say validators who are performing poorly, they get, as I said, penalized, slashed, etc. Then in the meantime, there's incentives into the network for the good players as well. But the thing is, what happens when, you know, let's say somebody was performing poorly, somebody lost money onto it. That's where this network token, which you just asked, comes into play. So basically, we take it out of the corporate, let's say, hands, and we distribute it towards basically the investors who have lost money without actually putting pressure onto the network by inflating the incentives or the actual token, the utility token which we have. So this is the bridge between the slashing of those proofs of stakes and let's say incentives towards people who actually lost money if they lose money on a default. And that's how, this whole transition turns out, so that people can actually recoup their, let's say, investments, not when they were wrong, but when they were misled. Let's put it
Mhm.
that way.
Absolutely. And that's
I
that's
mean, of course, any investment has a risk. So if you
mhm.
get it wrong as an investor, but the indicators were there, that's your, let's say, kind of problem issue. But if the indicators were in, let's say, AAA rating, global insurers, whatever it is, and then at the end of the day, it goes at a default, that's where, this network token comes into play.
And I think that makes a ton of sense. I wanted to underline the notion that those are two very distinct things you just outlined, Ivo, and I appreciate you distinguishing them. The notion that, hey, I go into a shop that, it has okay ratings, and I order, a blueberry ice cream, and it's not the best ice cream. I don't like it. That's on me. But if I order a blueberry ice cream and they bring me some pancakes, well, I have a reason to say, hey,
Exactly.
this is fraudulent. This isn't what I want. This isn't what I ordered. Misrepresented. And so a very important distinction there in terms of responsibility and onus. And I love the notion that investors have a level of protection, because one thing we've seen from 2008 is that there was iffy investor protections. Bitcoin comes about. And it seems as though in Web3, we've almost invented a casino-esque style, complete lack of investor protection market. And now we're seemingly going the other way entirely and fixing those woes of 2008 using that technology. So very exciting time to be in the industry where we're maturing a good bit now, which is nice. And so with that said, I'm curious in terms of bringing this back to the businesses real finance is serving. So you're targeting SMEs. These are small to medium size enterprises. Historically, these entities haven't had access to the capital channels of larger players, right? So larger corporates have tons of access to capital. The smaller the entity, the more limited the option. Could we walk through what specific pain points that real finance is solving for these SMEs? So I'm really curious in
Well,
terms of, as someone in business, what's that selling point for me?
just to clarify, I mean, SMEs in perception are, companies which have lower than 50 million in revenue. Some people might get a bit confused what are small and medium enterprises. So lower than 50 million revenue and lower than 200 employees. So, actually it's not a small company. I mean, it covers 90% of the economy in terms of corporates, right? So that's a huge market, first of all. And we are not covering and focusing only towards them, because the infrastructure is applicable for anyone, banks, financial institutions, anyone which wants to participate. What we're saying is that, instead of going for an SME, it's difficult to do an IPO. It's difficult to issue a corporate debt bond. For let's say 100 million corporate debt bond for an SME, it's difficult to do it. And you need to go through an investment bank, you need to go through brokerage services, etc., etc. Then you need to list on an exchange, which is you need to choose which exchange, which region, etc., etc. We're surpassing that, So basically, you do all of what, as I said, like you go to the custodial bank, you go to the basically to the tokenization company, etc., etc. You have 24/7 open market, zero settlement. So, at a fraction of the cost. It usually takes up to 7% for such kind of an issuance. On the blockchain, it might take a few $100. So, this is completely next, let's say, evolutionary step of decentralized finance and evolutionary step of traditional finance as well.
Hmm. Absolutely. The speed is a huge component. Like you mentioned, you want $200 and 24/7, or would you rather take the horse and buggy and be there in 6 weeks?
Exactly. Yeah, pretty much.
Very, very, very big distinction. Absolutely. I've analogized this to going from the horse and buggy to all of a sudden having Teslas in a hyperloop. I mean,
Yeah.
it's changing everything in terms of the speed of settlement. It's fascinating.
And
Curious as
again,
well.
no
Okay.
regional boundaries. It's also something which is
Mm,
very, very important. And if I'm a business, let's say, I don't know, in Hungary, I can get financed from the US or from Shanghai. I don't need to list on the Hungarian, let's say, exchange, etc. I mean, maybe
mm,
there is no market for the Hungarian exchange for my bond, but maybe there is a market, let's say, India for it.
And I think you touch on a really crucial point that we talk about a lot in the industry, though, is that liquidity fragmentation, right? We talk about how Ethereum has most of the stable coins, Tron has a huge amount as well. What about these other chains? But it's a very similar if you kind of blow this up to a national scale. It's the exact same thing. Like you said, if I'm starting a company where there's huge demand in the US, but I'm based in Hungary, that kind of blocks me out. Although I will put a little asterisk next to your statement and say, as an American, I still see the no US citizens allowed at the bottom of most RWA protocols. So
Well,
we're getting there.
we're getting there, yeah. I mean, with the current, with the new, let's say, regulations, etc. I mean, things are opening up a bit. I'm quite sure that they will open up even further. And as I have always stated, regulation isn't necessarily a bad thing. Uncertainty is, when it comes to finance, uncertainty is probably the biggest issue ever. So,
Mm,
yeah,
absolutely. Predictability is the friend of business. And the
exactly.
notion that you can overregulate just like you can overindulge in anything, but it is important to know the rules because if there are no rules, anything is possible.
Yeah.
And that gets really, really scary and a little bit messy very quickly. I would love to just, speaking very quickly for a moment, just turn it to the technical nerd side in me, Evo. I know looking through the docs, you guys are built on the Cosmos SDK with Tendermint. That gives you tons of interoperability. IBC super lightning fast, but naturally there's ongoing debates about the technical architecture in the back end. However, on the other side, as we've learned, businesses at the end of the day, they don't care about the tech. They just want it to work and to give them that real world business value. So could you just very briefly touch on that decision to go with Cosmos SDK and Tendermint? Just from a technical architecture solution, like what did that give you guys that maybe like an EVM architecture would not?
Well, as you mentioned, like the key word here is interoperability. I mean, we already have current existing partners. We do want to deliver a service which is reliable, which is, fast as well, and we do want it to be able to interact. Like, we don't want to create a closed ecosystem where only a certain few can actually participate. Like, we do want to have quite a big global outreach, and that's why we chose it. It has already, worked. So we don't want to think of let's say, we have the saying, we don't want to think of the hot water. I mean, it's already invented. We just want to adopt it in a manner where, you know, it would work for businesses, it would work for investors, and it can also interact with the existing counterparties as well.
A ton of sense. We've had exhaustive debates about EVM, SVM, any acronym you want to throw out there. And then from the technical side, that's been very fascinating. But I think we finally reached an inflection point where abstraction has won, just as we've seen with payments long past or the internet, right? I don't think anyone's ever said like, oh, you're hosting your website with GoDaddy? We can't talk. I only use this other web domain host. It's
Yeah,
like,
yeah,
just
yeah, exactly.
abstract it and make it easy for the end consumer.
Yeah.
Absolutely. And I'm really excited for just how easy it sounds like real finance is making asset tokenization and most importantly, tokenization and just making the tokens a comparatively easy part. That whole market formation piece that you mentioned, that is where rubber meets the road. And I know we were chatting before the show, and I know you mentioned as well, even in our conversation here, that the MVP launch is very close, complete with the core modules for tokenization, risk validation, insurance, et cetera. So it's really exciting time on the horizon. Great way to start out 2026. But as we look even further down the road, let's say like 2, 3, 5 years in the future, where do you see real finance and perhaps even more broadly, how do you see this infrastructure playing a role in the mass tokenization of the world's assets?
Well, I mean, I don't want to sound too confident, but to be honest, as I said, like, I'm very confident into the design of the business logic behind it and of the financial system behind it, because I have quite an extensive experience within the traditional financial systems. I have actually worked for, a couple of banks. I have worked for the interbank, basically lending and borrowing section, so interbank liquidity management, etc. And I do see real finance as a market leader when it comes to financial instruments on chain, 3 to 5 years. Um, I'm very, very, let's say, bullish and confident that there's gonna be billions onto the chain, and I'll tell you a reason why as well. I mean, the asset tokenization aspect is one thing, but the utility of those assets, so leveraging on them, using them as collateral, etc. The applications to them are immense. And when it starts from insurance, when it starts from creating derivatives on top of them, like basically the sky's the limit here when it comes to applications as to what you can do with those assets. So, assets which are, and I'm not speaking about illiquid, liquid. That's not the case. I'm speaking about, something which is, let's say, geographically positioned in Africa can be used as collateral in, let's say, Shanghai or whatever it is. And, these people are still not recognizing and seeing it, but this is happening. And also for financial institutions as well. I don't know how familiar you are with clearing houses, but the trilemma with the RWA trilemma, as we call it, it's also to a certain extent in traditional finance. So let's say if I'm a bank in Germany and I'm in need of short-term liquidity, repo deals, as they call them, purchase agreements. If I have assets and I want to sell them and I'm searching for liquidity, I need to go onto the, interbank market, and I need to, for example, get financed from another bank in Germany or maybe in the European Union. But the thing is, I'm limited to that. And that's how, by the way, indexes are formed when it comes to interest rate, interbank lending rates. So most referral rates for loans come from this baseline interbank lending rates plus risk premium. Problem here is that even banks don't trust each other. And that's why you have clearing houses. So if I am in short of liquidity, and at some point, I need to ask for liquidity from another bank. They charge me interest premium, etc. But half of the time I need to go through a clearing house to get access to that capital, and the clearing house kind of guarantees that I wouldn't default on this short-term loan, etc. With a blockchain system, this can all become, direct, zero settlement, full transparency, no clearing houses. And this is something which I'm very, very excited about. It's not going to happen today. It's not going to happen 6 months from now, but I'm quite confident that 10 years from now, that's how finance will move as a whole. Or you can use, once the assets are on chain, you can utilize them in so many different manners, even for financial institutions.
Love what you outlined here, Ivo, and I think it makes a lot of sense. And for those who are listening and maybe have a traditional finance background or thinking, you're going to get rid of clearinghouses. That's a lot. Not overnight, but I want to just draw the analogy between like ice houses, right? The notion that like, hey, if we need to keep stuff cold, you have these locations that are like little nodes across your city. Go get ice. That's cold all the time. That entire thing just fell apart quite quickly when a new and better way came around. Like the ice houses just aren't a thing anymore.
Yeah.
The notion that we're dumping all our assets in a clearinghouse, shuffled around and lent out based on the bank's desires, that can all happen programmatically. That's a lot of time and manpower saved, 100%.
No, and also like, a lot of finance saved as well. I mean, as I said, like, these, like a couple of smart contracts and, the right infrastructure can actually, cut your capex and opex very, very deeply. And I'm not saying that we'll get away with clearinghouses. I'm saying that they will adopt to the networks and to the technology which starts to exist. I'm not. I hate when people say, we'll get rid of banks. No, that's not going to happen. There are very strong business cases there, and people need them, etc., etc. I'm saying that banks will come into the technology. They will adopt to the new innovation, to the new, let's say, evolutionary stage. So it's kind of like fax, email, etc. Like basically, it's not that it's gonna disappear, or it will adopt. Companies will change the way they operate, and networks and infrastructures such as real finance will be there to actually help them adopt.
It makes a lot of sense. So, our need to communicate doesn't go away. It just kind of evolves and changes, similar to our need to have a financial custodian. I don't want to bury my gold in the backyard or gets dirt in it. So having those custodians is crucial. So any clearinghouses out there listening, you're safe for now. You just got to keep it. You got to keep it real. Boom. There's my joke for the podcast. But this has been phenomenal. Great insights. Ivo, you're clearly incredibly well positioned and well-versed to be doing what you're doing at Real Finance. Really excited for the upcoming MVP. Naturally, we at the foundation will be keeping an eye on all the exciting things that are evolving with the product and supporting any way we can. But with that said, would love to hear, where can we find you guys? Where can we find Real Finance or anyone listening who wants to get involved?
Well, we're currently basically most active. I mean, at the end of the day, we are into the crypto space, so we're most active at on our X profile, so RealFin official. You can find also on our website, of course, a lot of the information and Telegram as well. So all of our socials are very active. We're 24/7 there. Overall, we're very receptive to, like, as I said, we're building the community as we speak, and we'll happily answer any further questions of anyone who is interested. And in the next couple of weeks are gonna be very, very exciting for us, so people should pay attention to it.
No, absolutely. It's one of those things where it can feel like the sky is falling sometimes when markets do a downturn, but markets go up and down, and they've been going up and to the right over a longer time horizon. That's what RWA is all about. And so, Ivo, super excited for Real Finance. Like I said, definitely urge everyone who's listening to go check out what these guys are building. And with that said, we'll be in contact and discussing more of the exciting developments here in the near future. With that said, my name is Ray Buckton. I've been your host of the RWA Pod. I was joined by Ivo Grigorov, and we will see you guys next time. Trunks up.
Thank you.